Money Market Mutual Funds. Excerpts from the pamphlet, A Moment for U.S. Government Money Market Funds. Money market funds are a type of mutual fund. They are subject to stringent regulations under federal securities laws, most notable Rule 2A-7 under the Investment Company Act of 1940 that requires money market funds to maintain specific minimum liquidity requirements, to limit interest rate risk by restricting the maturity of assets they hold, and to limit credit risk by holding only high-quality short-term assets. Over time, the Securities and Exchange Commission has mandated Rule 2A-7, most recently in 2010 and 2014, in an effort to make money market funds even more resilient to financial market shocks. There are three types of money market funds. 1. Government money market funds invest 99.5% of their total assets in liquid investments including cash, government securities such as treasury bills, notes, and bonds, and or repurchase agreements that are fully collateralized with government securities. 2. Prime money market funds invest their assets in all types of money market instruments including short-term government securities, commercial paper including asset-backed commercial paper, repos, certificates of deposits, and Eurodollar receipts. And 3. Tax-exempt money market funds invest in short-term municipal securities, primarily variable rate demand notes issued by state and local governments. The interest income generated from an investment in a money market fund is typically passed through to its shareholders in the form of distributions. All income earned on government and prime money market funds is taxable. While there are use cases for prime and tax-exempt money market funds, the recent failures of two large U.S. banks underscore the value and utility of using government money market funds to ensure liquidity, protect cash holdings, capture yield, and reduce volatility in uncertain markets. Indeed, between March 8, 2023, when the news about bank issues began to emerge, and March 15th, U.S. government money market funds gained $145 billion in assets, while prime mutual funds fell by $18 billion and tax-exempt fell by $6 billion. A clear pattern exists that shows increased use of government money market funds in past periods of market crisis and underscores the utility of government money market funds as an important cash and liquidity management tool. U.S. government money market funds are among the lowest volatility type of investment. They look to provide a high level of current income while preserving capital and liquidity. According to the SEC, they generally seek to provide higher returns than interest-bearing bank accounts. Government money market funds seek to maintain a stable net asset value, NAV, per share of $1. Any excess earnings generated through interest on the portfolio holdings are distributed to the investors in the form of dividend payments. As such, there is no capital appreciation on money market funds. Income is generally calculated and declared daily and paid out at the end of each month. Dividends received as part of this distribution are taxable. Money market funds focus on holding short-term securities to ensure their liquidity. The SEC mandates that money market funds can only hold securities that have a maturity of approximately 13 months, 397 days, or less, and the portfolio holdings are mandated to maintain a dollar-weighted maturity of 60 days or less. As of February 2023, the Investment Company Institute reported that government money market funds were holding 82.4% of their portfolios in daily liquid assets versus an SEC regulatory minimum of 10% per Rule 2A-7, and that 88.6% of the portfolios were held in weekly liquid assets versus an SEC regulatory minimum of 30% per Rule 2A-7. Having a significant amount of the portfolio's holdings in highly liquid assets means that these assets tend to have much lower risk than equities, corporate bonds, or other types of securities. Conversely, these types of funds often yield lower returns than mutual funds that invest in other types of underlying instruments. Returns from money market funds, short duration, highly liquid assets are closely tied to interest rates. When interest rates go up, yields or income paid on money market funds tend to go up, and when interest rates fall, yields tend to go down. Money market funds work like a typical mutual fund. They issue redeemable units or shares to investors. For U.S. government money market funds, each share is equivalent to $1. When investors buy money market mutual fund shares, they are said to subscribe to the mutual fund offerings. Shares of money market funds can be purchased or redeemed through investment fund companies, brokerage firms, and banks. Transfer agents are responsible for recording each subscription and redemption, awarding the proper income to each mutual fund shareholder, and keeping the transaction record, including daily interest rate accruals for each and every holder of the mutual fund. Some money market funds are designed to attract institutional money by setting a high minimum investment, typically $1 million. Other money market funds are targeted at individual retail investors and tend to have small minimum investment sizes. Some money market funds can be bought for as little as $50 a month, making them within reach of most investors. Money market funds are not insured or guaranteed by the Federal Deposit Insurance Company, FDIC, or any other governmental agency. You can lose money by investing in a money fund. In the past, there have been instances where a money market fund has broken below the $1 net asset value target, but the funds that did were exposed to riskier investments than are allowed in government money market funds today. For example, derivative holdings or exposure to debt obligations. Along with other factors, we saw the impacts of these types of riskier investments in 1994, where a fund was liquidated at 96 cents per share, and again in 2008, where another fund's NAV fell to 97 cents per share. Since that time, the SEC has adopted amendments to Rule 2A-7 to significantly enhance the regulatory requirements governing money market funds and better protect investors. Thank you for watching my presentation on money market funds. If you are interested in purchasing a money market fund for as little as $50 a month, please call me at 845-476-4298. Thank you very much and have a nice day.